Hi there, Steve McKnight here to talk to you today about a market update and an outlook, given lots have changed in the property market of late, and it's worthwhile spending some time looking at some of the key drivers of the property market and what is the remainder of the outlook for 2010. Now, because there is a fair bit of information to get through, what I've done is I've broken up this video into segments. You can, of course, watch it in its entirety, or alternatively, for your convenience, we've broken it up into little segments as we go. As far as an overall summary then, let us take a look at some of the important points that are happening in the property market and the wider economy as a whole. And as you can see, the first one is that there is extreme volatility in equity markets. I know at the time of recording this, the Australian Stock Exchange is having a bumper day on the back of the US market going up 2%. Last week, the US was down 2%. And these wild swings of markets going up and down causes uncertainty. And when people don't know what to do, they end up doing nothing. And this notion of doing nothing can be quite dangerous because speculators stop taking risks. And they stick their head in their cocoon, if you like, and they're really afraid of taking on that next step. The second point to talk to you about is that we are actually in a very intriguing political landscape. You probably don't need me to tell you that. We have an election at some point later on this year, and the parties are posturing politically to try and determine who has the advantage going into a full-on election campaign. Clearly, Kevin Rudd has some issues at the moment with the resource super profits tax not doing very well, and opinion polls having him falling away quite considerably. Expect some ground to be made up though with some good old-fashioned pork barrelling. The third point to talk to you about then is a flattish property market. We'll look at some figures in a moment, but pretty much around the country in April, property prices were flat, declining in Darwin, Brisbane and also Perth. That said, does that mean that the property market's going to crash? I don't think so. It just means that, as I said to people at the get-together in sort of March this year, we're likely to have some good growth into June and then flat for the rest of the year as the market holds its breath and looks for direction. The next point to talk about is that whole notion of these factors combine to create uncertainty, and when people don't know what to do, they end up doing nothing, and then that stalls the economy at large, because instead of taking risks, employing people, buying new plant and equipment, businesses press the pause button, and then that results in stagnation with our economy and lower economic growth, sort of higher unemployment, those kind of things. The question we're asking ourselves then is, are we actually at a market bottom in terms of the property market? Has demand subsided? Or indeed, may we be going into a double dip recession led there by the United States and Europe with the uncertainty that's going on? It's a good question, and hopefully by the end of this little presentation, we'll have some kind of answer. The first thing that I'd like to talk to you about then is the notion of a market wrap and what has been happening to property prices around the country. You'll be looking at a screen now that shows you the outcomes for property prices at various different places. If it's too small to read, you can also download a little one-page summary that we've put together as well. This data actually comes from RP Data, and it's their April 2010 price summary. If you want more information about this, please do go to RP Data's website where you'll be able to download the press release. Taking a look at the figures then, we have Sydney leading the country with the most expensive house prices, $590,000, followed by Canberra, interestingly, that's done really well for the quarter. And then we have the others. Melbourne, which has recorded the highest year-on-year growth so far at 17.6%, has actually had quite a flat quarter. You'll notice that the columns that I've got on this table for you are quarterly change and yearly change. I don't have monthly change. I just ran out of room, but if we looked at the monthly change, as I've said, the monthly change is flat across all the capital cities, declining in some. What this tends to indicate is that the recent good times that we've had, if you like, have come to an end, and it's not really surprising. 6 interest rate rises and some general malaise amongst the European economy will do that to any market. And our property market, which has recorded strong growth, has probably overshot itself a little bit and now needs to pause to catch its breath. Interestingly, looking at this information and looking at the yield, which is the annual rent divided by the purchase price, the highest yielding capital city in Australia at the moment is Darwin at 5.4%. Brisbane's doing well at 4.2%, Hobart 4.9%. So those investors that are looking for yield returns or cash flow returns may be well placed to look in those particular areas and try and find a high yielding deal. The lowest yielding capital city in the country at the moment is of course Melbourne, 3.6%, and that's justified on the basis of the recent price growth without large increases in rent at the same time. What can we say then? We can say, generally speaking, while there's been uncertainty and volatility in equity markets, the property market has performed very well indeed. Melbourne 17%, Sydney 11%, Darwin 14%, Canberra 13%, Australia as a whole 11.5%. The underperforming cities remain to be Brisbane, and that's really because they oversupplied into the last property boom and it's catching up, and Perth. Perth hasn't caught a light again, but that said, it's not going backwards. What are some observations then? Again, summarising, there was little or no growth in the month of April. It was actually the lowest monthly gain in property prices in Australia since December 2008 in the midst of the global financial crisis. Perth, Brisbane and Darwin all declined, and the housing indicators, things like auction clearance rates, housing finance, those kind of things are all unfavourable at the moment. And that is pointing to a relatively weak property market in the second half of 2010. Now, is that a problem? No, I don't think so, because the RBA is actually trying to jump on house price growth inflation. And one of the ways they've been doing that, of course, is to increase the interest rates. An interesting observation that came with the commentary by RP Data was what has happened to non-capital city markets, and non-capital city markets make up 40% of the market in April, or made up 40%, but only those non-regional, those non-capital city markets only got 50% of the capital gains that capital city markets got. And that goes to show you that the boom that happened in capital cities, in particular Melbourne and Sydney, didn't translate into regional areas. And for investors, that means that you'll probably find, again, better yield returns in regional areas where the rents have remained the same but the property prices haven't gone up. So if you're a cash flow investor, I would certainly not be looking in capital cities, generally speaking, at the moment, but I'd be looking at those larger regional hubs as places where good yield returns may be in the current market. Another observation was that house prices are pretty much tracking. There's a strong correlation between house prices and household disposable income. On the back of the government handing out money last year, household disposable income was very high, the stimulus packages, etc. But this year, household disposable income is forecast to grow at less than 5%. And that means that if there is a strong correlation between household disposable incomes and property prices, again, for the remainder of 2010, it's not pointing to a particularly strong market. Recent gains were not as a result of a speculative price boom. That means that investors didn't drive prices up. Now, this again is an observation by RP Data, and what it says to us is that the growth that has happened is not like a sugar rush. There is some sustenance to it, although it is not sustainable into perpetuity. Again, if there are people watching this who are wondering whether the recent property price growth was an aberration, it was a spike and it's due to collapse, the statistics are not confirming that point of view. In fact, the statistics are saying that no, the growth that we've had in the property market is actually sustained. We may get some quarters of negative growth, but it's not like this massive speculative boom like what happened in the UK and the US leading into the global financial crisis. The Australian banks are quite strong, and on the back of the Australian banks being quite strong, the property market is holding up well as well. A market wrap then, the three areas that I'm targeting for the second half of 2010 as being potentially good areas to invest are Sydney. I think for reasons I'll explain in a minute, the government's announcement as part of its budget that it is removing stamp duty for first home buyers and also for empty nesters with strings attached will be really good for the housing market in Sydney, and that will spill over into the rest of the country. But I think there is opportunity for Sydney house prices, particularly new properties, up to $600,000 to grow in value quite quickly, bearing in mind there is planning issues. But again, I'll talk about that in a second. Adelaide, I was at a recent business breakfast where an economist from the Commonwealth Bank said something which I thought was very insightful, that the next big mining boom in Australia is probably likely to happen in South Australia in terms of infrastructure development. Until now, not much has happened in South